Today, I'm talking about relative strength, relative weakness, and understanding money rotation in the market. Relative strength and relative weakness is one of my big layers of probability that I'm constantly paying attention to in my own trading. As a matter of fact, I think for the calendar year of 2021, for this trading environment, understanding relative strength, relative weakness, and understanding institutional money rotation has really been the key to success in this year's trading. So first of all, what is relative strength? What is relative weakness? So you can have relative strength between a stock and its sector, a stock in the market, or between a sector and the market. For example, today maybe the S&P 500 is up 0.5%, but you're looking at financials and they're up a full percentage point. We would say that financials are relatively strong compared to the market. And now maybe amongst those financial stocks, maybe JP Morgan is up 1.5%. So we would say JP Morgan is relatively strong for the financials. So I've got a sector that's relatively strong compared to the market. I've got a stock that's also relatively strong compared to its sector. Now, if I was looking to go long a stock today, I'm gonna have a higher probability of success by going along the stock that has the relative strength. I'm gonna have a higher probability of success going long the financials, which are up a full percentage point today, than going long maybe energy, which maybe is flat on the day when the market's up that 0.5%. Why are the financials strong today? Why is energy weak? Well, it has to do primarily with institutional money flow. If the big money is rotating for whatever reason into financials compared to energy or tech today, then that's what's gonna create the relative strength. Now, in the year 2021, it's been an interesting year, and relative strength and relative weakness has been key. A lot of that has been derived off of interest rates. Interest rates have been a really hot topic this year, as everyone's been discussing when the Fed is gonna start tapering their bond purchases, and potentially when the Fed is going to start increasing interest rates. So it's important for me as a trader to have an understanding of how a movement in interest rates based on the Fed can create order flow into the market from institutions that breeds relative strength or relative weakness. Let's not make this too complicated. Let's think about it conceptually here for a minute. So if interest rates start moving higher, because the Fed increases interest rates, or because the Fed begins to taper, if I have higher interest rates, well, what sectors is that gonna be good for? What sectors is that gonna be bad for? Higher interest rates tend to be better for banks and value type sectors like energy, materials. Let's think about banks for a second. Well, how do banks make money? They make money off of interest rates. So if interest rates move higher, most likely you're gonna see banks having relative strength. And now for me as a trader, I'm trying to figure out what I wanna buy. Well, I know interest rates are moving up. I'm going after the relative strength in the financials because that's where I'm gonna get the most bang for the buck on my trading. What about interest rates compared to tech? Well, higher interest rates tends to be bad for tech. Why? So many tech companies out there have been reliant on the fact that money has been basically free because they can borrow at interest rates that are at 1% or close to zero is what the federal government's borrowing at. So a lot of these tech companies actually run at a loss because they're trying to gain a really big user base or whatever it is, increase that revenue growth, and then hopefully have that transition into profits at some point way down the road. Well, if I'm a tech company and I'm running at a loss, but I'm relying on the fact that I can raise more money for basically nothing, and now all of a sudden it costs me money to raise money because interest rates are higher, that's bad for my business. So higher interest rates tends to be bad for tech. So this is all where the relative strength and relative weakness dynamic has come from in the calendar year 2021. And for me as a trader, understanding that dynamic, paying attention to how treasuries are moving, how interest rates are going up and down, and how that is affecting money rotation into different sectors like value as opposed to tech, and seeing that constant money rotation moving back and forth, That's how I need to position myself as a trader to maximize my probability of success for what I'm doing. If you like what you learned today about relative strength and relative weakness and you want to learn more, well, first of all, make sure you click on that like button, make sure you hit on that subscribe button, and also check out the link that we have in the description area so that you can learn more about how you can become a part of the Pro Desk virtual trading floor and my team of traders that I'm working with on a day-to-day basis.